Good morning and welcome. I'll call to order the September 20th, 2023 Mendocino County Board of Retirement meeting. Ms. Zeller, if you will please do the roll call.
Mr. Land?
Here.
Mr. Kelly?
Here.
Ms. Cavanis?
Here.
Mr. Jurdy?
Here.
Mr. Cromer?
Here.
Ms. Harris? Here. Mr. Anderson?
Here.
And Ms. Cubison?
Here.
Mr. Shoemaker is absent today.
Thank you. If everyone will stand for the Pledge of Allegiance.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
That takes us to public comment for items not on the agenda. Members of the public are welcome to address the board on subjects both on and off the agenda, but the board is prohibited from taking any action on those items that are not on the agenda. Do we have any public comment at this time?
There is no public comment.
Thank you. Item number 1 is the consent agenda. Our consent agenda is approved by unanimous consent unless a board member requests separate action on an item to be pulled. I'm not seeing any such requests, so the consent agenda will be approved by unanimous consent. Item number 2 is discussion and possible action regarding investment matters. I know we have the Callan monthly investment report. Is there any comments or discussions regarding that report? Any public comment regarding 2A?
There is no public comment.
Thank you. Item 2B will be, yes, Mr. Anderson.
Thank you. Just a clarification question. When I was looking on the financial report, I saw that there was a withdrawal from domestic equity. I didn't see a corresponding investment. I don't know if it was a timing thing.
No, that was just a cash draw
It was a cash draw.
for operations, yeah.
Thank you. Any other comments or discussion questions? Seeing none, item 2B will be our educational presentation regarding IFM Investors Global Infrastructure Fund. I see we have numerous members online to provide that educational session. Go ahead.
Good morning. Can everybody hear me? See me?
We can hear you and see you. You're loud and clear.
Perfect. Well, thank you all for taking time this morning during your meeting to meet with us. What I thought we would do is brief introductions, do a quick refresh of IFM. I know I had the chance to meet with many of you in person back in late 2019. But for your benefit and those who weren't in attendance there, we can do a quick overview, go into the just an update on the performance of the fund, including updates specifically to Mendocino County, and then I understand there's interest in hearing our some views from us on the energy transition opportunity set. So I'm going to pass it over to my colleague Natalie to cover that. I know you will interrupt us if you have questions, if there's anything else that we can be answering along the way. Otherwise, we'll just keep going through it. And I might ask Natalie just to do a brief introduction to herself and then back to me, and I'll go through the first slides of the presentation.
Thanks a lot, David. Pleased to meet everyone today. My name is Natalie Bolus. I'm the Vice President, Infrastructure Equity Product Specialist at IFM here in the New York office. So I work very closely with David, Chris, and other members of the BD team to support our existing investors, as well as act as a bridge between our team and the infrastructure investment team. I've been with IFM for over 2 years now. And prior to that, I was on the transaction side working in investment banking in New York, where I was working on infrastructure transactions across the US and Canada. So I'm pleased to talk to everyone today about the energy transition.
Thank you, Natalie. And again, I'm David Eltruller. I am the head of our global client solutions team for North America. Been with IFM for about 6.5 years, and excited to be here today. So Natalie's controlling the presentation, I believe. So Natalie, if you want to flip to the intro slide. Perfect. As I mentioned, I think several of you are familiar with IFM, but I'll do just a brief overview of the firm for everyone here. We are a little different than other investment managers in that we are owned by pension funds, retirement savings plans. They founded IFM back in the 90s, almost 30 years ago, in Australia, and those pension owners still are 100% owners of IFM today. There are no additional owners in the business. That group, which you'll see on the left side of the slide, has gotten smaller in terms of number, and that's purely due to consolidation and mergers within the Australian retirement savings superannuation industry. But no change in the ownership structure since we were founded. We were initially set up to invest in infrastructure on behalf of those institutions in Australia and then globally. And infrastructure equity investment is still the largest piece of our business. And particularly offshore from Australia, it's the vast majority of what we do for folks like you. We did launch an infrastructure debt strategy over 5 years ago, and we have a number of investors outside of Australia in that, but the remainder of the business, and in particular the listed equities, is still managed on behalf of Australian investors. Next slide. Our infrastructure equity platform is one of the largest in the industry. We code this by color so you can see the products, but that total 73 billion in funds is divided between the Global Infrastructure Fund, which we'll be referring to as GIF here. That has a little over 57 billion in equity. It was established in 2004. We had a fund that preceded that, same strategy, although only investing in Australia. That fund is still open. Still have a number of investors, not only in Australia, but also from offshore, including the US in that fund. That was established back in 95. And more recently, we launched a dedicated fund to focus on a piece of the energy transition opportunity, which again, Natalie will touch on later in the presentation. Next slide. No real change in our investor base other than growth. We have today close to 600 investors in the Global Infrastructure Fund in GIF. It's all institutional. And on the right side, you'll see that while we are founded, or we're founded by Australians and still have a number of Australian investors and significant funds under management from Australia, North America is actually the largest market now with respect to investors in the Global Infrastructure Fund, including a number of other California counties and the two largest funds in the state, CalPERS and CalSTRS. Next slide, Natalie. I want to start with an overview of recent performance for the fund. We're going to turn to your performance in a minute, but this reflects the performance of the actual vehicle that you're invested in. As an open-ended fund, investors come in and they effectively have their own specific return based on when they are drawn into the fund. but this gives a high-level overview of how the fund has performed over time. We do have a target return of 10% net, which we guide investors towards thinking about as a range of 8 to 12% net of all fees across cycles, as we are a long-term investor. The fund has been within that range. You'll see since inception, 2004. That includes a global financial crisis, a global pandemic, most recent market volatility. So we're really proud of the performance that we've delivered to investors. That is a net total return number. You'll see under that a 5.4 net cash yield since inception. That figure represents the cash yield in the form of distributions to investors over these periods. So of that total return, investors have received pretty significant periodic distributions from the fund, and that comprises both proceeds from operations of our assets, where there's excess cash flow that gets distributed, as well as from some of the divestments or sales that we've had from the fund. The other number I want to call out on this slide is the weighted average leverage. We get asked about that a lot. There is no leverage at the fund level, so this is leverage that is used at the asset level, and we keep that at a very conservative level. It's about 35% as of June 2023. If you look at similar funds that are targeting core infrastructure, you'll see that number close to 50% or higher. We've been very, very focused on using leverage as prudently as possible in terms of both the quantum, so not putting a lot of debt on investments. We don't look to use debt to boost the returns. And also the debt itself is very conservatively structured. So think that 85% plus of that debt is either long-term fixed rate debt or hedged out. So we're really trying to minimize any refinancing risk, as you could imagine, coming into this period of higher interest rates. We really didn't want to be in a position of having to go to the market to refinance. So we did a lot of refinancing of the portfolio over the prior years when rates were basically zero, very attractive rates. We use primarily investment grade debt. And again, because it's fixed rate, that interest rate sensitivity doesn't really flow through directly to the fund through the debt that we are utilizing. Last slide before I pause on the performance is your performance to date. I'm just going to touch on this, what these numbers are for your benefit. So there was an initial commitment in February of 2020. We drew that entire commitment down in December 2021. So you were fully drawn then. During that period, obviously, there were no fees. There was an additional commitment made in 2021, which we drew in 2023. You have seen distributions from us of about 481,532 to leave your ending balance with us as of August at 25,816,000. We calculate your return based on your drawdown dates with us, and that is 9.29% net of fees. So I'm going to pause there. That was a lot of numbers put out there. Just want to make sure there aren't any questions before we move on. Perfect. All right. I'm going to just move into the firm a bit and our strategy. We're going to start with the team. It's the largest team in the industry, focused on global infrastructure, with a lot of significant senior leadership and tenure we're organized by region. Kyle Mangini is the global head. He's been the global head effectively since the inception of the fund. He joined in 2007. He's American, although been based in Melbourne, Australia the whole time. And then we have three regional heads. Julio Garcia for North America here works with us in New York, Deepa Bharadwaj in Europe, and Michael Hanna in Australia. The team is organized around a couple of functions. We've got the investment team that is focused on the origination and finding those deals, and then they stay on those companies once we make the investment. So there's not a transfer of ownership or responsibility. They stay on, continue to serve on boards of our companies, and so forth. We also have an asset management specialist team, and that's a little unique. It's a team that sits across the global investment team, whose sole responsibility is to work across our portfolio of investments to identify both opportunities that they can see to reduce risk and create value. And so they take experience from one port in one region and bring it to another. They look for synergies across the portfolio where we can, for example, benefit from the scale that we have in a particular sector or geography. They look to take best practice that they've seen implemented in a particular company or region and see if there's ways, particularly around areas that we're very focused on, like health and safety. There's something that we've learned from or could benefit, take from one experience and bring it to benefit another, we do that. So they're constantly getting cycled around the portfolio around strategic initiatives. They get brought into individual companies to work alongside the management team. So it's a great benefit to the platform, and allows us to do what our thesis is, which I'm going to get to, which is really to take a very long-term view on investments. But because we hold ourselves accountable to this target return to deliver to you all, we have to be thinking all the time, how can we find value? How can we unlock value? So it really is what we look at as a buy and manage strategy. These are not bond-like investments. There's a lot of moving parts that we have to think about from a risk perspective, but also where there is opportunity for us to create value. Next slide, Natalie. Those of you who attended the presentation back in 2019 would remember this slide. What we do hasn't changed at all since the inception of the fund. We continue to focus on three primary sectors and infrastructure: utilities, energy, and transportation. And what we look for are opportunities to invest in assets where there is as much visibility and predictability into what is driving the revenues. That predictability can come from things like regulation that says that the regulator's obligated to remunerate us and our company in a certain manner based on delivery of services. That predictability can come from long-term contracts with off-takers or counterparties that specifically outline what the obligation is in terms of utilization of these facilities and then payment to us. That obviously provides a lot of certainty of the revenues. And we're also invested in marquee assets in particular sectors and geographies where, because of what they are, they have these market barriers that protect them. And think about some of the large airports that we own and operate, which we'll touch on. It's very difficult to build a competing facility such as an airport, and that position within a market, the barriers to entry, monopolistic characteristics provide a lot of stability and predictability of the revenues. And that's really what we've been doing, and we don't expect any changes to our strategy. Next slide, Natalie. I won't go too much into this. As I mentioned before, we're looking to buy the right assets. We manage them intensively using that asset management team I talked about. And as when I was talking about the performance, and we'll get to in a minute in terms of recent activity, we will sell investments where we see an opportunity to take advantage of a particular situation in a market and to deliver those returns back to investors. I'm going to touch on a few of those. Natalie, I think if you want to turn to the portfolio slide, this is a snapshot of that the portfolio as it stands today, what you're invested in. It's a combination of investments we've owned for several years and investments that we've brought into the portfolio more recently. So over the past 5 years, we've executed on about 15 in new investments or follow-on investments, representing about $21 billion in capital. So very active strategy, a lot going on in the portfolio. I thought I would call out a couple of more recent investments that we made, particularly since you all have been drawn in to the fund, just to give you a sense of what we have been doing in the portfolio. And I will start with Sydney Airport, which you will see to the far right column there at the bottom. Sydney Airport is one of the largest global airports. It's also one of the oldest airports, operating airports. It's the key international gateway into Australia and the largest airport operating in Australia. So we're almost the vast majority of the international travel comes through Sydney Airport. Sydney Airport had been listed on the Australian Stock Exchange in March of 2022. Last year, IFM, along with a small consortium of other investors, including our largest owner, Australian Super, took private Sydney Airport. And today we operate this as a group. We invested about $3 billion from the Global Infrastructure Fund into that. And we did so having followed the airport for several years prior. It was considered one of these once in a generation opportunities. IFM and others have been following that airport for a long time. We saw how the airport had performed during the pandemic, so got a real look into what happens when an asset like this is challenged by things such as government shutdowns, which most investors don't have a lot of experience with, at least prior to the pandemic. And for us, it is a complement to several other Australian airports that we own, so we bring a lot of market and industry experience. Performance has been quite strong, and as of June, passenger levels were just under 2019 levels, so it's pretty much rebounded to where traffic was prior to the pandemic. That's really been driven by leisure travel, people wanting to go travel the world, having been on lockdown. I'm sure you all heard about how severe that was in Australia. And also return of business travel. So really exciting addition to the portfolio, complement to what we do in airports. At the end of last year, December, we completed the acquisition of another take private, the public company in December called Switch. Switch is a US-based data center operator. It provides critical digital infrastructure to a marquee group of companies that rely on increasingly high quality, high demand data to manage their businesses. This is first data center investment by IFM. We went into it having spent a lot of time looking at the industry, trying to find those characteristics that I talked about before, where there really is that predictability in the revenues. What we really liked about this business is that it uses proprietary data center design that is very attractive to high quality customers looking for focused on things like uptimes, power usage, and other efficiency standards. on that point, 100% of the facilities are powered by renewable energy, which is clearly a nice thing from a climate perspective, but energy consumption is one of the most critical line items on the expense side of the balance sheet for data centers. So having that basically all through renewables was a huge advantage. A very diverse customer base at acquisition. There were over 1,000 individual companies, very low churn. Once they get in, they stay, and the company had a longer than 20-year track record operating in the space. So we felt very comfortable with that investment. So those were two larger, newer investments in the portfolio. I want to touch on too some of the exits that we've had recently. Starting at the beginning of this year, in January 2023, we sold 25% of M6 tolls. If you look on the page there, you see that on the bottom with the UK flag. It is the only tolled route in the UK, and we sold 25% of that to a group of UK pension funds called GLIL. So local investors, we actually invest with them in one of our other investments in the UK, Anglian Water. So familiar buyer to us, no change in from our standpoint from a governance perspective. But what it did was allow us to sell down to a like-minded known party at a premium to where we were holding that investment prior quarter, and then those proceeds come back to the fund and also potentially to investors. So it's a great way for us to diversify the portfolio, take some money off the table, and do so in a way that where we're able to manage the business from a governance standpoint and from a shareholder standpoint. And the last transaction I'm going to talk about before I pause was a sale of a portion of a business we own called Global Container Terminals. Global Container Terminals is on that bottom row. It's based in Vancouver, Canada, and comprises 4 seaport terminals. 2 in Vancouver, and there are also 2 in the US in the New York, New Jersey harbor. When we acquired Global Container Terminals, which we call GCT, we had identified what we saw as a strategic direction for the business, focused really on Canada. The US terminals were considered to be non-core to the business long term. Really, the competitive dynamics weren't as favorable as they are in the Canada terminals. So we elected to make that acquisition, but had always been considering that we would sell down the US portion in the right market conditions. And those market conditions presented themselves to us. It was actually late end of last year. And then there was just a pretty standard review from a regulatory standpoint of the sale. We sold to a shipping company at what we think is a really attractive valuation. It streamlines the business, and to us is a real demonstration of the market for high quality port infrastructure in the North American market. So another great outcome. We just officially closed it last month, so we're going to be working through the how to allocate the proceeds from that investment. It's another great outcome for the fund and for investors. I think I'm going to pause there. Before I turn it over to Natalie, just want to make sure and ask if there are any questions about your current investment, Global Infrastructure Fund, anything else that I can answer.
Trustee Harris.
I noticed that you have an office in Hong Kong.
Correct.
But no investments
Correct.
What's going on there, and what are you specifically looking at and for? I mean,
Sure.
obviously, there are challenges there, but also incredible opportunities, so I'd like just a little background and what you're looking to invest in at this point.
Yeah, absolutely. We opened an office in Hong Kong a few years ago. I want to say it was 2018, with a view to thinking about a couple of opportunities for us. The opportunity at that point, and it still stands today, is that a number of our businesses operate in they're global in their nature. A lot of the flow of whether it's goods or commodities, minerals, oil, gas, etc., flow through global networks, and we identified Hong Kong as an important hub for us to be in Asia, where a lot of that business is tied to or flowing through. So we did open that office, put a few investment professionals there, really to be part of that global flow of opportunities related to our current investments, market insights, relationships, and so forth. And while developed Asia is not a focus of the fund per se, it's not a target market like North America and Western Europe, we did want to have boots on the ground in the event that opportunities did present themselves. So we have looked at a number of opportunities in, again, developed Asia, in transportation and in energy. For us, though, we have yet to transact on an investment in Asia. For the fund, it's quite a high bar for us to be able to find an investment that works for this fund, given the size of the fund. So, if it's a very small investment without a path to growth or follow-on investment, it really won't move the needle. But also from a risk perspective, this is a core fund, and we want to make sure that we're investing not only in companies but in jurisdictions that we really understand and can get comfortable with from a risk standpoint. So I do expect over time the portfolio will diversify, but that team is still very busy contributing to the management of our global investments today.
Thank you.
Trustee Jurdy.
So I don't know if this is the right time to bring it up. Are you going to talk about investment opportunities going forward, or is this the right time to bring it up?
It is the right time to bring it up. I think what I'll do is, Natalie, maybe I will pass it over to you, and you could maybe touch on what we're seeing generally in terms of opportunities, which does dovetail, I think, with the energy transition space. So maybe you could start with just the broader pipeline and kind of generally what we're seeing.
Yeah, absolutely. So the Global Fund, we continue to be focused on our 3 target sectors. So looking at opportunities in the utility space, in midstream energy, as well as in transportation. And, we're looking right now at a pipeline of around 9 billion, and that's sort of spread nicely across both those sectors and across the geographies that we're focused on. I think when we look at what we'd like to add to the fund, one area of focus, or certainly two key areas of focus. One would be a focus on digital infrastructure. So David alluded to this, but we made our 2 initial investments in the digital infrastructure sector in 2022. So the second was Switch Inc., the portfolio of data centers that David was mentioning. And then the other transaction was at the beginning of 2022. We entered into a fiber joint venture with Deutsche Telekom called Glasfaser Plus. So this is an opportunity for us to partner with Deutsche Telekom and roll out fiber to the home to over 4 million households in rural Germany between today and 2028. So with those 2 acquisitions, we went from having no digital infrastructure in the Global Fund to close to 6%. So it's an opportunity. We feel very strongly that that for the right transaction, digital infrastructure does fit squarely within the core infrastructure remit of GIF, and it is something that a diversified infrastructure fund should have access to. And then the other major opportunity set that the team spends a lot of time on these days is in the energy transition. You know, if you talk to Julio Garcia, the head of the team in New York, what he'd tell you is for every 10 transactions that the team is looking at, 5 or 6 of those is an energy transition. So, and we see our opportunities as well, both in the renewable space, which at this point in time is quite mature, as well as in newer sectors that I'll talk about momentarily, including low carbon fuels, hydrogen, electrification, and carbon capture and storage. So as an investor in the Global Fund, you have renewable exposure in a couple of ways. The Global Fund did make an investment in the Net Zero Infrastructure Fund, so you have some exposure there. And then it's also a core part of our decarbonization strategy for our portfolio companies to be rolling out behind the meter solar to reduce their individual carbon footprints, as well as to diversify their businesses to make them appropriate for a net zero economy. And I can talk more about that momentarily.
Okay, thanks, Natalie. Hopefully that gave you a good overview of what we're focused on next in the fund. Before I pass it over to Natalie to go a little deeper into energy transition, just want to make sure we cover any questions about the Global Fund performance.
So first of all, I think this looks like it's maybe our all-star in our portfolio. At 9.29% return, very stable. It's not, as I understand it, it's not really liquid though. So can you clarify that? One of the issues that all pension funds have is when their total portfolio is down because of the volatility of stocks or some other portion of their portfolio, then the long-term investments like the infrastructure, as I understand it, are basically not accessible. So can you just clarify that?
Yeah, I'll start, sorry. The fund you're invested in is an open-ended fund. We bring in investors each quarter to invest in the fund, and we also offer quarterly liquidity from the fund, meaning that there is an ability for investors, unlike with a private equity type or closed-end fund where your capital is locked up for the duration. There is an ability to on a quarterly basis receive liquidity. There's another liquidity mechanism as well, which is the distributions I mentioned. Each year, investors may elect whether or not they would like to receive distributions from the fund in cash or reinvest those distributions back into the fund. And those reinvested distributions go before we take capital from new investors coming in the fund. My understanding, this is something we can follow up on if you like, but for Mendocino County, my understanding is that you have elected to reinvest those distributions. So there is that ability, as I mentioned, at any point during the year to reach out to us. We can process any change in that election for the following year and thereafter until we hear back from you.
David, before you
pause
proceed,
there.
I think our financial investment officer, Mr. Ravelis, has a comment.
Yeah, I just wanted to reiterate to the board that last year, you may recall when the denominator effect started pushing some of our real estate and infrastructure up to the upper bands of our target allocation ranges, we did stop reinvestments of the real estate. We stopped reinvestments with JP Morgan Infrastructure Fund, and we did attempt to stop with IFM, as David's already mentioned. You really get that election option before December of any given year, and I was a little late in getting to them on that re-election, so that's an allocation that we're watching. currently, and as we get closer to the end of the year, we'll determine if we need to actually make that election or not.
Thank you, Trustee Jurdy.
So yeah, so my follow-up on that is this is actually almost too good to be true. So we get a long-term strategy through your consortium, which I really like because the structure is an association of public pension funds, and so I believe inherently in the DNA of the organization, there's more of our interest in mind than we would get with a for-profit investment company. It's personal commentary. But secondly, there's also, which I was not aware, the ability to access some of those some cash in the case if other parts of our portfolio were down, such as public stocks. Because that's I would say the number one reason why people would say, oh, you need bonds in your portfolio, because when stocks are down most of the time, although not all the time, bonds are not down. And so then you rebalance your portfolio by tapping into the bonds. But what you're telling us is that because you were set up by a public pension funds, you've created the system where there is the ability to pull out some cash, whether it's essentially the equivalent of dividends or actually withdraw some of our principal. And with that in mind, I'd just like to point out to the board that when we have 22% of our portfolio for the last 10, 15 years only earned 2.1%, which was our bonds, that meant that in order to achieve 66.75% total return, the remainder 78% of our portfolio had to earn 8.10%. Going forward, if 22% of our portfolio is bonds, and if going forward, and I don't believe it's going to happen, but if going forward they earn 4%, the remaining 78% will still have to earn 7.6% just to achieve 6.75, which I think is a really low target. I think we can earn 7%. And an example, if we had 20% of our portfolio in infrastructure funds like this one, and if this fund going forward only earned 8%, 9.29, the remaining 80% of our portfolio would only need to earn 6.75 have a total portfolio return of 7%. So you can see, in my opinion, how bonds have been putting tremendous stress on the remainder of our portfolio. And this seems to me a much smarter investment. Instead of having 6 or 8% of our portfolio in the IMF fund, it seems like we ought to be looking at something more like 20%, especially given the liquidity that we just heard about. So, but later on, I did want to talk about some unique investment opportunities. I'm not specifically thinking of Mendocino and Sonoma counties, but because we are in a joint powers authority here in Mendocino County with Sonoma County and Sonoma Clean Power, we are aware of what's happening statewide in a way that other elected officials, other county supervisors would not necessarily know, because we're on a board that are purchasing power. We're seeing the growth in the consumption of electricity. We're seeing a shift away from older technologies to generate that electricity, and new investment that's happening in California, not just in Mendocino and Sonoma County, but I'm aware of things that are happening here in California that I just want to make sure that you're aware of what's happening in California, because in particular, it's geothermal. The state, a good chunk of future power in California is going to come from geothermal. We have a lot of opportunities in California, not just in Mendocino, Lake, and Sonoma counties. But we're in Sonoma, Mendocino, and Lake, we're deploying newer technologies that are replacing the 1970s version of geothermal with federal grants that are helping to subsidize this newer technology to scale it up to market. And I just think that there's definite opportunities in the transition to clean electricity, the increasing demand for clean electricity. As you said, I mean, the data centers are using more all the time. Besides people transitioning from gas to electric vehicles, it's a clear growth investment opportunity, and I'm sure you're aware of it. I just want to make sure you're aware of everything that's happening in California, because I think what's happening in California is going to scale up nationwide, in the future.
Sure. Look, thank you for that. We do follow California, where we've actually heard a little bit more about what you've been describing through our your counterparts in Sonoma, who have been longstanding investors with us and ask very similar questions about plans that we have or familiarity we have with the utility market and developments, not only in your area but across the state. So it is something I think, Natalie, you have some additional comments to make specifically about that, which I'll let you. But look, we agree with your assessment of kind of how to be thinking about this allocation. The one thing I will note is that we do we do have a queue to get back in the fund. So investors, when they think about liquidity, it isn't exactly the same as a like a mutual fund or a stock where you can sell and then just easily come back in. As you saw, you had to wait a little bit to get back in the fund. But it is absolutely something, if there are questions about liquidity, how it works, we're obviously in regular contact with Robert, but always happy to address any questions there. And specifically, definitely let's make sure that if there's an intent to change the distribution election for 2024, that we don't lose sight of that before the end of the year. It's not a very long process at all, but I don't want to lose sight of it if that's something that's on your mind. Natalie, any further comments you want to make about the utilities market in California and our thoughts?
Not particularly at this time. I mean, we're across the transactions that are happening in the space. I know there's some questions about the PG&E spinoff earlier this summer. We certainly keep across what's on the market. I say there's not really transactions that we don't take a look at. And I think, I'll talk about this in a bit, but long story short, we agree with you 100% that the energy transition presents an enormous opportunity. I mean, so much so that we have launched a standalone fund to address these opportunities, and that these opportunities are also going to come across the risk-reward curve. So we see everything from an extremely core set of opportunities in the transition space to opportunities that are more on the like private equity and venture capital end of the spectrum. I mean, all I can say more generally about using infrastructure as a fixed income substitute, there are certainly investors in other geographies that do take that position. We see a lot of Canadians with much larger infrastructure allocations for exactly that reason.
Thank you. Mr. Revelis.
I would remind the board and Trustee Jurdy specifically that the board has reviewed the strategic asset allocation earlier this year and did settle on that. So while Trustee Jurdy has consistently brought up his concerns, which we are separately addressing, the board has essentially set that strategic asset allocation target, and that's what the investment system process is following. Specific to infrastructure, we are overweight. We're not planning on pulling funds. We're planning on trying to get back to target while at the same time maintaining the levels of liquidity that we need, which is about $9 million a year.
Are we overweight because of the underperformance of other categories?
Well, we're overweight because of a reluctance to pull funds from our real assets, specifically real estate and infrastructure. Now, they've also performed well. That's been good for the portfolio, as Trustee Jurdy's pointed out. Over the last year, the other asset classes have been challenged. We're all aware of that. Bonds have been challenged for a lot longer than just 1 year, but last year, calendar year 22, was a specific outlier in that not only were there recession concerns, but also inflation concerns that directly impacted the fixed income allocation and the public equity allocations.
So my comment regarding this is, there's some people that are here that were on the board when we made this decision regarding infrastructure and some that were not. And my recollection personally is that we were looking for ways to diversify our investments to hopefully limit some of the volatility we've been experiencing in other asset classes. And I took it personally that this board historically and currently is very deliberate with their decisions and actions and methodologies in investment asset classes and decisions relating to those. And I took it as dipping our toe into the pool to check the water, and the water's been better than we expected. So I'm supportive of investigating and reporting back on the possibility of changing that allocation, with the understanding that we do things very deliberately and that investment may not be pulled immediately from IFM or any other group that we choose to invest in. So that's my comment regarding that discussion. Any other trustees have comments regarding what we've been talking about or where we're at? Trustee Anderson. Very far. Yep.
Thank you. This question's to Mr. Revelis. Is it, I know as a fund is now a mature fund and only going to remain that way, is that liquidity is an important issue, and we discussed that when we discussed our asset allocation model. But as you described the $9 million roughly this last year, my recollection is that it's kind of been in that $10 to $12 million range for probably a decade. So our cash needs or need to generate cash from this investment has been somewhat stable. Is that accurate?
Absolutely, yeah. Yeah, in fact, I feel like it's been declining. The amount of cash we actually have to pull has sort of gone down a little bit through efforts of, in part of that's because of the payroll schedule at the county. Another piece to that is through communication towards the courts and sort of reinforcing their need to continually and consistently send over payments.
I would like to mention the reason that net cash need has remained around that 9 to 11 million is in large part because the employer contribution rates have increased, as Mr. Jurdy has acknowledged, rather significantly in the last decade, because the employers and employees are providing more cash now than they did a decade ago is the reason why we're not seeing larger cash draws from the fund. Now, as the employer contribution rate would be expected to go down as we get closer to fully funded, Siegel in their annual valuation provides sort of a projection of where the employer contribution rate, and it's targeted to go down, I think, in around 2036 and then drop off rather significantly, assuming all other things held constant and we made all of our actuarial metrics. However, once those employer contributions go down, what you would see is a larger cash draw because our liabilities have increased. But the reason it has remained relatively constant over the past decade is because the plan sponsors are paying more because of a higher contribution rate because of the unfunded liability.
Trustee Harris, did you have a comment? Okay. Any other comments? Natalie, I think we're clear to go ahead.
Thanks. And before I get going, I just want to do a time check. Initially, we talked about wrapping up around 9:30 Pacific. How much time do the trustees have?
We have a limited agenda today, so I think we're good. We do have one trustee that has to leave at 10, and he can excuse himself when needed.
Okay. I think that's more than enough time. I planned about 20 minutes of remarks, and then I thought I'd open it up for questions.
That's perfect.
So
Go ahead.
thank you, David. Excellent. So it's maybe let me jump right into the energy transition. So at a very high level, as I'd mentioned previously, we also take the view that the energy transition that's going to happen between now and 2050 presents an overwhelmingly large opportunity for an infrastructure investor like IFM. So when you read about the energy transition and sort of what's needed in order to meet the goal of maintaining global warming to only 1.5 degrees Celsius, estimates differ a lot. McKinsey estimates that over 50 trillion of investment will be required by 2050 in order to achieve this target. Another number I've heard thrown around is that around 4 trillion per annum will need to be spent. And that's across the economy as a whole. So it includes, in addition to infrastructure sectors such as renewables and electrification and battery storage that we often think of in the context of the energy transition, that applies equally to decarbonizing agriculture or reducing the carbon footprint of our buildings. So there are a lot of opportunities, but even drilling down into infrastructure, we see a number of opportunities in both mature sectors as well as emerging segments like geothermal that you've mentioned. So I think, to my mind, that's the first remark to contextualize this. I think the other factor that's really important to keep in mind when we think about the energy transition, as well as how we can participate in that, is that it's going to be very slow. And traditional fuels such as oil and natural gas are going to continue to be a part of the energy mix for many decades to come. So looking at forecasts from, for example, the US Energy Agency, we're expecting to see, even under a wide variety of transition scenarios, more rapid transition or slower transition, even in the most optimistic scenarios, oil and natural gas will be an important part of the energy mix many decades into the future. And if you think about that, it makes sense both because significant developments are required to decarbonize hard to abate sectors like transportation and heavy industry. Also the fact that, especially here in the United States, we're very reliant on cars. So the transition to electric vehicles will be slow. And then finally, also thinking about home heating, for example, and the individual investments that need to be made there to decarbonize those parts of the economy. So what that means for IFM is that we see both opportunities to transition our existing infrastructure assets from brown to green, and we are doing so at the Global Infrastructure Fund. And we also see opportunities in already decarbonized assets that we're seeking to access through our Net Zero Infrastructure Fund. So the reason we decided to launch a standalone strategy last year was both because of the scale of the opportunity set. We thought that, as these are both open-ended funds and we are a long-term buy and manage investor, the thinking was over time, these net zero opportunities could potentially overwhelm the Global Infrastructure Fund. And we want to maintain that as a balanced core infrastructure portfolio. And then also, it was in part driven by investor demand. So we have a number of investors who want the opportunity to specifically capture greater exposure to net zero opportunities, as well as those investors who have specific mandates, for example, to invest in impact strategies or low carbon strategies. So that's sort of the context of how we're thinking about the transition more generally. And then I can dive into talking about how we bucket these opportunities before talking about some of what we're actually doing here at IFM to move the transition along. So when we think about transition opportunities in the infrastructure space, we've really bucketed them into 4 pillars, is what we call them. So the first is renewable power and battery storage. And I think, especially being in California, you're very familiar with this. Renewable power, I mean, the technology is vastly more mature and widespread than it was even 10 years ago, right? Today, solar and wind account for 10% of global power generation, which I think is pretty incredible considering it was basically 0 10 years ago. And today, its installation of renewable capacity is the single cheapest form of energy. So there are overwhelming trends there. That being said, and you know this better than most, there is an overwhelming need to pair intermittent renewable generation with battery storage. Solar and wind are great when the sun is shining and the wind is blowing, but battery storage is essential for managing the grid. I mean, in California example, you see very clearly how the duck curve has gotten deeper and deeper over time. So when you look at power demand over a 24-hour period, net of renewable generation, you see enormous demand in the morning when people wake up and the sun isn't shining yet. Demand dips very steeply in the middle of the day when it's very sunny, and then comes up in the evening when people get home and they want to turn the lights on and make dinner and get ready for bed. So in order to manage that demand and some of the complications it causes for the grid, battery storage is an essential component. In California, for example, installed battery capacity has gone from only 0.2 gigawatts in 2018 to nearly 5 gigawatts in April this year. So that's an overwhelming ramp up, and I think we still see a lot of investment opportunity there. The second pillar that we're focused on is electrification, and this is closely related to my earlier comments on renewable power generation. So the existing grid is old. It's very susceptible to extreme weather events, which are becoming more and more common. You see this in wildfires in California and Hawaii and other parts of the world. You see this in extreme cold conditions like we had in Texas a couple of years ago. So there's a need to both weatherize and strengthen existing grid infrastructure, and then build out the grid to support the future electrification of the economy. I think, as something that really jumped out at me is for every EV that gets put on the road is the equivalent of adding 2 additional houses to the grid. So if you think about moving to a solely electrical, automobile in the United States, moving completely away from gas, the amount of grid infrastructure build out that's required is just over $500 billion over the coming decades. The third pillar that we're focused on through our Net Zero Infrastructure Fund is in the low carbon fuel space. And we see opportunities here both in the near term and in the longer term. So near term, a big focus is on renewable natural gas. So there are a couple of areas where we do see RNG opportunities. Some of those, there are a lot of opportunities in the dairy space, and those developers that are focused on the low carbon fuel standards in California. Where we found opportunity through the Net Zero Fund earlier this year, we were able to acquire an RNG developer focused on capturing waste methane emissions from wastewater lagoons. So it's sort of an underserved part of the market, but the really cool thing about it for us is that when you capture waste methane, and the RNG that you produce from it is actually it's also net carbon negative. So we're able to sell that gas to off-takers under long-term contracts. And these are voluntary off-takers like Mercedes-Benz, for example, who are interested in reducing their carbon footprint. The other useful thing about renewable natural gas is that it's a drop-in fuel. And so it doesn't require any change to our existing natural gas infrastructure. You can process it, inject it at the injection point, and then burn it the same as natural gas. And then the fourth area where we see a lot of opportunity, albeit further into the future, is in carbon capture and storage. I mean, if you think about it, even if we do get to a point where our economy is carbon neutral, we'll still have a need for removing excess carbon from the atmosphere and sequestering that. Carbon capture is also useful for potentially pairing with hydrogen generation or other high emitting processes that are hard to decarbonize otherwise. So that's kind of how we think about the opportunity set. I'll pause there to see if there are any questions, then I can talk a bit more about what we're seeing at our portfolio companies.
Trustee Anderson.
Yeah, I had a question. When you look at the just the energy area, and you look at kind of the vertical integration of what's happening. Currently, we have gas and oil extraction that'll be replaced with mineral extraction. At some point, you're going to have to look at, when you look at batteries and these types of things, look at the waste management portion of it. And I'm wondering, from an infrastructure standpoint, are all of those kind of viewed as kind of drags on these technologies, or are there early signs of new infrastructure in the area of waste and or mineral extraction that are actually potential opportunities?
I think that's absolutely a great question. And really gets at a fundamentally important point, right? It doesn't, to some extent, doesn't matter if our energy is clean if we're destructive when we extract minerals, and then destructive when these technologies phase out of their useful life. So that's been very important for us as investors. When we consider investments, we're thinking about them on a whole life cycle basis. So and that's upstream in terms of supply chain and making sure we're sourcing minerals and sourcing components from reputable suppliers who are in compliance with best practices, and then also recycling our technologies at the end of life in a way in which we're able to reuse as many of the components as possible and then responsibly dispose of those we can. And all of that is considered as part of the initial investment package. I think,
sorry, Natalie, not to interrupt you. I would just would highlight again sort of where we come into the life cycle. And as an infrastructure investor, we are not involved in that extraction process. I think what you've hit on is a really important point and consideration for the industry when you think about not only the governance around and environmental impact of extraction, but in the jurisdictions where this is occurring, they're often outside of the sort of the remit of the focus of groups like us who are targeting making those capital investments in U.S., Canada, Western Europe primarily. So it's something that I think the industry is effectively reckoning with, but we are the supplier of that infrastructure, transportation infrastructure, processing infrastructure for be it oil, gas, fossil fuel, petroleum products today, but also mining commodities and so forth. So I think it's something for the industry, like in general, to be educating itself on. What we believe, though, is that over time, that given the amount of capital going in, there's increasingly these companies focused on whether it's mining or E&P upstream extraction, focused on using technology today to make more sustainable, less impactful of a process of extraction. So particularly when you think about carbon capture, starting early on at that point of E&P exploration and production is very common now. So I'm pretty confident technology and capital is following these processes, recognizing, as Natalie said, how critical they're going to be to affect the transition. You can't just turn these off. The other thing is that, as Natalie was talking about with the low emission fuels, a lot of this is involving recycling of emissions, and methane is a key emission that, with a significant environmental impact, is a focus of strategies that infrastructure investors, including IFM, have been focused on, how we can capture methane as a byproduct and use that for purposes of substituting um, um, uh, natural gas, oil in energy generation. And we do have one platform that we have invested in to date on the broader IFM infrastructure platform through the Net Zero Fund that is a focus there, and that's something that we'll look to continue to do. So you all, through your investment in the Global Fund, will have exposure to effectively this recycling of what would otherwise be just dirty emissions, methane, into the supply of energy generation as a substitute to fossil fuel.
Thanks for those comments, David.
Trustee Harris.
No, I take it what David. I'm sorry.
We have another question. Trustee Harris.
From flatulence in cows, how would you even begin to look for business opportunities that can capture that?
I think I only caught part of the question, but is it how do we address methane emission from cows?
Yes, you caught the gist.
No, like I think it's a great question. I think we're certainly aware. I think like as people today, we're more aware than ever of the varying sources of methane and other harmful emissions in the economy, including cow farts. I was surprised to learn a couple of months ago that one of the top sources of methane emissions is actually rice production. So even if you go vegetarian, you're still creating greenhouse gases. I think so. When we look at RNG, so those who are focused on the dairy industry tend to the focus is on processing the dairy manure, and the benefit of doing so is because there are kind of two sets of subsidies in the United States, where some are focused on RNG for use in the transport sector, and then California has the low carbon fuel standard, which is specifically targeted at this dairy manure. And those subsidies are pretty attractive to developers. The waste emissions that let me flip to the slide so we can look at the seed portfolio that David was referring to. But Green Gas, our RNG company, is focused on waste lagoons. So these are for certain animal or let's say vegetable processing. And basically what you can do is put a tarp over it, is the way the technology works, and then you're able to capture methane that would otherwise just go into the atmosphere. And so it is really not, I mean, it's a small company, and it's a small component of, global carbon emissions, but I think it is a good step forward for us to think about how we can take these harmful emissions, remove them from the atmosphere, and turn them into something that we need to fuel the economy. And I think, David's kind of touched on this, but I think if we are going to achieve these ambitious net zero goals, it's the phrase I always like hearing is it's not a silver bullet, it's silver buckshot. We're going to need a whole basket of technologies, some of which have not been invented yet or are just in very early stages. And it's going to necessitate a very rapid, creative, and multi-tiered response across every single country and every single sector of the economy. Don't know
Yeah,
if you
and just rounding out on Natalie's comments, I think what you've hit on is what we see and we as an industry see as a potential opportunity. Our business, Green Gas, is focused primarily on poultry waste, methane generated from that. But the same technology, my understanding, is used for slurry liquid cow patties that are put into a lagoon and covered with a tarp in order to trap the methane, and then used to loop into pipelines to generate gas and distribute. The challenge really comes down to it's expensive technology. It's you've got to find a way to kind of build a scale to make it commercially attractive. And then for us in particular, as a large infrastructure investor, we have to make sure that we understand not only the market, any particular regional dynamic subsidies, other pieces of financing that would impact our ability to create an investment structure that would work for a fund, and where we could go to you all and say, hey, look, we found this great opportunity. It's not only a fantastic investment from a return standpoint, but we're able to contribute to the decarbonization of a area through trapping cow waste, methane, and so forth. But there's a lot of considerations that go into an investment from a fund like us before something becomes effectively prime time. But the good news is we've actually started going down this road with what we think is a fantastic platform in Green Gas. And the thesis will be, being a long-term open-ended fund, we'll be looking for complementary opportunities to help build that scale and use the management experience that they've developed with a particular type of waste emissions and so forth. What can we learn from that? How can we leverage that to expand, be it into other types of waste or other regions, and so forth. So that's IFM's approach. How can we take something that that works today in the context of an investment structure and see if there are opportunities not only to increase the value but also build scale. So to my knowledge, no direct cow waste
I'm sorry.
emission activity today, but it is definitely the direction that the industry and to some extent our fund is going.
Thank you.
Trustee Jurdy.
So understanding that this fund can't invest in every single opportunity that's out there, two thoughts. One, going back to what Trustee Anderson brought up, I think he might have been getting at, because of the need to recycle these electric car batteries that are soon going to be ending their life cycle. My understanding is that there's pent-up demand for businesses to expand to recycle the material into new batteries or to other products. So I don't know if that is one, an investment opportunity that this fund has the bandwidth to look into or not. And the second one was, I noticed on your slide earlier, you talked about biofuels. And I remember seeing Richard Branson at UC Davis at the Governor's Climate event, maybe in 2006, 2007, predicting then that one of his many enterprises was looking at some kind of biofuel that was going to be more or less carbon free for jet fuels. And his contention was that that it would take a significant infrastructure investment to switch the fuels that are distributed at your local gas station, but it would take significantly less infrastructure to retrofit airports, because there's just fewer airports out there. And so anyway, so I don't know what's happening with that. That was in 2006, 2007, but it did seem like a logical presentation made by Richard Branson.
No, those are both great points. On the EV charging, the battery recycling. I was going to make this point earlier, but the conversation sort of went in a different direction. But absolutely, there are opportunities along the value chain for investors to take advantage of, and I think IFM we've seen opportunities in the mining sector, and that could be new technologies, that can be new companies that are trying to find better ways of extracting the minerals, and then this can be downstream as well when you get into battery recycling. I think we have to think strategically about where we're best positioned. IFM is a core infrastructure investor, so when we think about where we want to play in the transition space, the Net Zero Fund is really focused on these extremely core infrastructure opportunities. So a focus on mature technologies, proven cash flow, contracted or regulated returns, very straight down the middle, lower risk, steadily returning infrastructure opportunities. And that's not to say that obviously battery recycling is a very important part of the transition, and there are certainly opportunities there for other investors to kind of take advantage of these mega trends. But for the time being, the segment of the market we've chosen to focus on is sort of a mature, de-risked infrastructure sector. And then on the low carbon, sorry.
Oh, sorry, Natalie, go ahead.
Well, I was going to switch gears and talk about sustainable aviation fuel. I'm glad you brought that up because that's something that could potentially present an opportunity for the Net Zero Infrastructure Fund, but I think it also dovetails with a lot of the work we're doing at the Global Infrastructure Fund. So IFM several years ago, we made a commitment to achieve net zero across our infrastructure portfolios by 2050, as well as achieving an interim carbon reduction target by 2030 of 1.86 megatons of tons of CO2. And so we're doing that in a number of ways in order to reduce the Scope 1 and Scope 2 emissions of our portfolio companies. A major source of opportunity has been, as I mentioned, building out behind the meter generation. So to give you an example of that, Vienna Airport, one of the 3 airports in our portfolio, recently completed a 24 megawatt solar project that's sitting at the airport itself. So this is the largest solar project in the country of Austria, and it's helping substantially reduce the airport's emissions because instead of buying dirty power from the grid, we're able to generate our own clean power on site. But the question remains, what can we do to reduce the Scope 3 emissions of our assets? So the emissions of the end users of our facilities. So at an airport like Vienna, how can we help the airlines reduce their carbon footprint? And sustainable aviation fuel has been an important part of that. And we've been a key mover in that area. So for example, at another one of our airports, Manchester Airports Group, we just this past year, we became the first airport in the UK to have a dedicated SAF hookup. So sustainable aviation fuel is available to all of our customers there. We've also delivered sustainable aviation fuel through our midstream pipeline infrastructure in the United States. So Buckeye and Colonial Pipeline delivered sustainable aviation fuel to New York area airports just this past year. And the advantage of sustainable aviation fuel is it's a drop-in fuel, and you can mix it up to around 10% without suffering any performance impacts or needing to retrofit any of the existing infrastructure. So we certainly see a lot of opportunities there.
Maybe to summarize Natalie's comments, I think that there's really 2 key takeaways for folks like you invested with us. One is that all of this stuff's very exciting. There's a lot of interesting things going on from a technology standpoint. A lot of opportunity, like you talked about, in terms of life cycle and recycling of components and so forth. The challenge is that it's got to get to a scale that's not only commercializable, but also from a infrastructure, core infrastructure standpoint, where we can really understand the risks, ring fence those risks to make sure that we're not exposing ourselves to market risks that we don't understand, technology risks that we don't understand. When we go back to the returns we've generated, the predictability, stability that's come from that kind of thinking. So I think the good news is, in particular with the Net Zero Fund, it's bringing a lot of focus, resources for IFM into these areas, so that we can understand those risks, understand where the market opportunity is, understand what kind of technology risk a fund like ours is comfortable taking, isn't taking, and even start participating in these opportunities. But it's got to kind of become prime time for us, and it's got to make commercial sense. So this sustainable aviation fuel, which Natalie talked about, Manchester Airport, we're thrilled to have this be, I think, the first airport in Europe with this kind of hookup, but it's expensive. And so the airlines have to decide, is there enough of a business case for them to pay that premium for that more sustainable fuel with less carbon emission, and we want to be there to make sure that they have a supply to that if it does make sense. But it ultimately has to make business sense for the customers, and that's something that is not really in our control. So just, we always have to be sort of realistic in terms of what a fund like ours can do and what it can't do.
Just a final wrap-up question. So we know that we've earned 9.2% during the time that we've been invested in the fund, your global infrastructure fund. And we've talked a little bit about your net zero infrastructure fund, which is a sort of a distinct separate fund. What, during the same time period, did the investors in the net, maybe we don't have the answer right now, but I'm curious, what would have been the return on our investment had we invested also some amount of money in the net zero fund? Was it more than 2.1%?
Do you want to cover that?
Was it more than 2.1%?
If you give me a minute, I think I have the number ahead of me. I think I can give you an answer, and then I also want to go back to what David was saying about there being a difference between the fund return and the return that individual investors get. We're still continuing to draw new investors into the net zero fund. But since inception, actually, David, do you want to talk while I pull this number up?
Yeah, just going to look up the number to make sure that it's current. But look, the fund's done well. What I want to caution is that it's very early days for this fund. So the way that the valuations work, just briefly, is we do make an acquisition by the fund, and then we have a period where we keep the valuation at acquisition, typically for a period of the first year, before our independent valuers will then revalue that investment. There has been, in general, but also in the case of the Net Zero Fund, an uplift, because we tend to take a pretty conservative view when we bring an investment into the fund from a valuation standpoint. So in the early days, you sometimes see a pop in the returns, which has been the case for some of the investments that we have made in the Net Zero Fund. So just cautioning you that it's a good question, but it's not a like for like comparison to the global fund, which, it's been very mature, and we just don't expect to see much volatility up or down in the performance period to period.
That being said, I have the answer in front of me. Since inception, the Net Zero Infrastructure Fund has delivered a 27.3% return to the global fund, which you're invested in. And
so that return, again, just to clarify, is
Yep.
really not a reflection of anything to do with what we call risk or anything. Kind of, they're great investments, but it's more of a kind of typical valuation process that once investments go from being put in the fund, to their first valuation cycle wins the time you get the fresh eyes on an investment by valuers. So we do expect this to normalize over time. But yes, had you come in early into that fund, you would have effectively benefited from that uplift directly. You did benefit from that uplift through your investment in the global fund.
And then just finally, you referenced that there were other public pensions, in particular, it sounds like in Canada, that have replaced or largely replaced bonds with infrastructure. Do you have examples of other clients, other public pensions, whether they're in Canada or the United States, where you could share that with us, maybe not at this moment, but could show us what percentage of their total portfolio is in any of your funds?
Yeah, absolutely. We can follow up with Robert on that and share what we do have. A lot of it's obviously from public sources, but we do see allocations by asset class, including infrastructure globally. You do see some Canadian institutions will have allocations to infrastructure at 15% or higher of a total plan. But we can give you some concrete examples. I think in the U.S. It's to gravitate more to that 3 to 5% of the total plan. As investors become more familiar with the opportunity set, they've tended to increase it. I do just want to caution, it's an equity investment, not a fixed income investment. A lot of investors have taken proceeds from their fixed income portfolio to put into infrastructure, given its defensive characteristics and this nice combination of that kind of lower risk, but equity-like return. It really is going to depend, obviously, on the type of strategy that you're investing in. But yeah, let us follow up with you all, and we can give you some examples of where we've seen some higher allocations to infrastructure from our client base.
Any other comments or questions from trustees regarding the presentation? I personally appreciated the very thorough and thought-provoking educational session, and I think it's given us numerous things to talk about and think about.
Great. Well, thank you all very much for the time today, for your support over the past few years, and obviously we look forward to working with you in the future, and we will follow up with Robert on anything else that we can be helpful with.
Thank you, Natalie and David. Have a great rest of your day.
Great, thank you so much.
Ms. Zeller, do we have any public comment regarding this presentation?
There is no public comment.
Just to poll the rest of the trustees, is there a desire to take a break at this moment, or should we push through for the last remaining items? Thank you. Takes us to item number 3, the fiscal year 2022-2023 final budget report. Our financial investment officer, Mr. Reveles.
Trustees, you have the final fiscal year 23 budget update memo and reports. Not a whole lot changed, but I pointed out the few items that did change. I'd be happy to answer any questions or concerns you have.
I didn't see any surprises. I don't believe this needs any action, just receive and file.
That's correct.
Any public comment regarding item number 3?
There is no public comment.
Thank you. We'll consider it received and filed. Item 4, discussion and possible action regarding record and data retention and destruction policy. Our Executive Director, Rentschler.
Thank you, Chair Cromer. Trustees, this policy is an update to the record retention policy the board previously has adopted. That one was due for review in 2019 before I started, but it had been postponed. When I took a look at it, I realized that I think I wanted to make some substantive changes, and I've worked with counsel on this. The red line of the policy is presented. It includes some new sections on covered records and electronic and imaged files, and the schedule has been updated. I apologize that the schedule doesn't provide a comparison red line. If you have questions, I'm happy to address any questions you have regarding the draft policy.
In general, was the schedule increased or decreased, or did it go both ways?
The schedule, we just added additional document types, so it covers more specifically types of records and specific retention periods. In some categories, if all of the documents of the same category had the same retention, the retention period is listed at the top with the category, as opposed to one for each individual record type.
Trustee Anderson?
Just quick question, because it is an overhaul as you described. Is it primarily based, kind of have like legal origins, or is it just the fact that we're moving from a paper environment into a digital environment, or a combination?
It's a combination of the two. Certainly, we have more and more electronic records and fewer paper records. The paper records we get, we convert to electronic records as far as all of our member files. As far as Pension Gold and its integrated document management system, there are some requirements as far as how that system is designed as far as access and limitation on records to ensure that it would meet qualifications under the California Secretary of State's office as a trusted system for an electronic document management system. And ours does, to our knowledge, after working with LRS regarding the Pension Gold and the PageX system there. But it's also broader. We have a lot of records that are maintained with the county that are not part of that specific document management system. So most of these edits were worked out with counsel to cover both aspects, documents within a document management system and documents that we maintain outside of that.
Any other questions or comments regarding this proposed policy? Do we have any public comment regarding item number 4?
There is no public comment.
We have a motion
Second.
and a second. Any further discussion? Ms. Zeller, will you take a roll call vote, please?
Yes. Mr. Land?
Aye.
Ms. Cavanis?
Aye.
Mr. Jurdy?
Aye.
Mr. Cromer?
Aye.
Ms. Harris?
Aye.
Ms. Cubison?
Aye.
And Mr. Anderson?
Yes.
Approved.
Takes us on to item number 5, discussion regarding the administrative report. Executive Director Rentschler.
Thank you, Chair Cromer. In the administrative report, I would like to bring your attention to the fact that we do have an election going on. The nomination period for submitting declaration of candidacies opened on September 11th, and that is open until October 10th. So we are still soliciting candidates. We do have a candidate for the alternate retiree seat and for the general member seat at this point. There is a reminder to complete your board performance evaluation. Please complete it by September 29th. The results of the evaluation will be presented at the October meeting. In addition to questions on the board's performance and how the board interacts, there's an educational assessment sort of at the bottom, which gives you an opportunity to give us some input as to topics you would like to see come up during board meeting educational sessions. So we would certainly like your feedback there. I did mention that the December meeting is not our typical third Wednesday. It's the second Wednesday on December 13th. We have a staffing update. Maddie Sample left us and went to social services as an IT technician, or whatever the proper phrase is. So we do have a recruitment open to fill the Retirement 1 specialist position. And we had 42 employees attend the fall pre-retirement seminar, which was in person here in this room. And there's a legislative update attached that I would like to bring your attention to. We will have the SACR's board packet presented hopefully with the next meeting, so the board can provide direction as far as voting at the SACR's meeting in November. If you have any questions, I'm happy to answer any questions you may have regarding the report.
Trustee Anderson?
Just a quick question as to the status of the Board of Supervisors' actions on the executive director contract.
My understanding is it's scheduled for the consent agenda for the meeting next week on September 26th, to my knowledge.
That's my understanding as well. It's more of a comment than a question. I would just like to encourage any members of the public or in any other of the units that can run for a position with the board that they reach out to our executive director. She's very receptive and available to meet with any prospective candidates and explain what this role is and the commitment it takes. So, any other comments? Trustee Harris.
Oops. I was able to attend the retirement conference that is in this room, and I was so proud of our staff. Obviously, our fearless leader, Doris, but also Judy and Nora just did an outstanding job, stood up for womanhood, and captivated the crowd. It was just professionally, beautifully done. Thank you.
Any public comment regarding the executive director report?
There is no public comment.
We'll consider it received and filed. Takes us to item number 6, general board member discussion. Trustee Land.
So I just wanted to mention that I attended the CalPERS pension, what do we call it? Principles of Pension Governance, and I really liked it. It was a great time. I recommend it for anybody who's starting out and wants to learn a little bit about what we do here.
Perfect.
It was quite an enjoyable experience.
Very good.
Yes.
At Pepperdine, yeah.
Yeah.
Any other discussion?
I had a quick question on one of the items that came up earlier, and I didn't know if it was appropriate to save it for now. And it had to do with the reinvestment of some gains in, which fund was that? And yeah, Robert had said that it would put us over our allocation for that particular fund if we didn't cash out, so to speak. Is that true? Or is that inaccurate?
Our real estate and infrastructure is already over our target allocation, in part due to an additional commitment that was made, I think it was to a real estate fund. Both over a year ago. We had added more money to the real estate and infrastructure funds right after the market was up quite high. Then, of course, the market has come down and it left our infrastructure and real estate holdings over our target. As a way to help bring those back into the target allocation without actually having to sell out from any of those positions is that we've turned off automatic reinvestment of the dividends on the real estate funds and on the JP Morgan infrastructure. When we reached out in February to the funds, IFM said you would have had to have requested it by December of last year in order to not reinvest dividends this year. So we will be looking at whether or not we need to stop reinvesting dividends. And we'll make that decision by December of this year, and if necessary, stop reinvesting dividends in the IFM fund for next year. That would also provide us with some of the operating cash, since we are pulling roughly $9-10 million a year in cash, because it would give us some cash every quarter. Did you want to add anything?
So, I guess what my question is, though, is, do we have the flexibility as a board to make last-minute adjustments to that if we would prefer to stay in the fund, even if it goes over our targeted amounts?
According to our investment policy, Robert's job is to rebalance the portfolio to keep us near our target allocations and within a plus or minus allocation as far as a range for each asset class. The board did adopt recently the asset allocation plan. Now that could, of course, be revisited at any point in time. Typically, that's done every 3 years or so in conjunction as part of the asset allocation study. The asset liability study. So with that, Robert's job is to help rebalance the portfolio to keep those target allocations in line.
And I would also note that we're not rebalancing fully, for instance, into bonds. We're maintaining, we're maintaining that allocation shy of, it's in the range, but it's at the lower end of the range. So there's a range, and that's what we're working with. Yeah.
Trustee Jurdy.
So I'll just add a little more. So it's true that Callan did come to us with their recommendation for a portfolio mix, which was a very, very modest change to our current allocation. They did recommend taking 8% of our U.S. stocks, although they didn't describe it that way, but increasing our allocation to bonds, which effectively would have decreased our U.S. stock allocation by 8%.
Their recommendation wasn't actually to do that. They did give 3 or 4 different models, and the board action was to select the more conservative portfolio that had the higher allocation to bond. But Callan's comments themselves were that they were not necessarily recommending any change or move to that, and that they had suggested staying with the current mix we had at the time they presented that asset liability study.
But I would point out that at no time can I recall that Callan's ever shown us what their expected standard deviation, that's volatility, of stocks, U.S. stocks, international stocks, bonds, infrastructure, et cetera. They've given us, here's a proposed allocation formula. And I feel like that lack of information, that lack of background information has been detrimental to the fund because, for example, while we didn't see what was the standard deviation, I don't think, from the presentation we just saw today, there are many ways to construct a portfolio, and I feel like they've been giving us sort of pre-baked formulas for asset allocation, and not the components that make, and not the details that we need to understand the components that make up the allocation of the formula. And as I've been pointing out, with lower volatility stock portfolio, we could have more stock. Another example, if infrastructure is less volatile and has higher returns, we could have more money allocated to infrastructure. And the presumption that bonds are always essential to a total portfolio, I think, is not proven out when you're looking at yields that are substantially below your target return for the total portfolio. The concept, and I'm not jumping on the 60-40 portfolio is dead bandwagon, but when bonds were historically earning 6-7%, they were close to a target return for your total portfolio. When they've just earned us in the last 10-15 years 2.1%, they were a drag on our portfolio. They weren't even close to our target. So they were making us rely heavily on I would say, very volatile generic stock portfolios and maybe not meeting our target. And so if we can take a fresh look at our portfolio in a way that Callan has never done for us, which is to look at what's the volatility of each of the different kinds of asset allocations, and how can we mix and match those allocations to achieve the volatility that we're looking for, which is not a lot of volatility, but it's allowance for some. What's the cash flow we need? We just heard from Doris that because the employer and the employees, but mostly the employer, have been putting a whole lot more cash into the plan, we're not pulling money out of our investments in the way that we used to, because the cash flow is coming from the employer. So if that's the case, I mean, I'm taking it to extremes, but to what extent do we even care about volatility if we're not drawing that much out of the investments? Or put another way, if we only need to draw out a little bit of money out of our investments, maybe it's not out of the total portfolio. So I'm just saying that, you know, what we've done here with listening to Callan, and I think giving us partial information to go with their advice, that we have migrated the target return, and I've supported this until now, from 7% now to 6.5, now to 6.5. We're putting, it's because we've relied on, in my opinion, way too much money on a low-performing dog in our portfolio, and that's the bonds. And it's putting pressure on the employer. The employer is now paying 40 cents for every dollar in salary for pension contributions. For the general employees, it's more than that for public safety. And we're paying 70 cents in benefits. Actually, it's more than 70 cents in benefits for every dollar in salary, more than $1 in benefits for public safety for every dollar in salary. And this is not sustainable for this county to be paying so much money into this pension fund. We have got to take a fresh look at our portfolio and how to reconstruct it in a way that does not, and I think an honest, fresh look at our portfolio would either say either no bonds or it's less than 22%.
So before we continue, I think we're getting beyond the intended purpose for general board member discussion. I believe there was a request included in Trustee Jurdy's statements for further information and maybe a presentation from Callan, which could be agendized in the future. I believe our financial investment officer may have had a comment there, but I'm trying to warn from venturing too far off the beaten path of general board member discussion.
Yeah, so we are continuing to work on the review of the portfolio. We are directly addressing Trustee Jurdy's concerns at the next meeting. What I would also add, in defense of Callan, now they tend to be relatively conservative. They have helped shepherd the portfolio over the last decade to almost 7.5% net return, which is above our expected returns on an actuarial value basis. Another thing I would note is that Callan does provide all of that information that Trustee Jurdy just mentioned. So he mentioned that they don't provide standard deviations for asset classes or the portfolio, and that's not true. They do provide that. In the capital market assumption document, they provide all of that detail. Now, the board may have never specifically looked at it unless you're trying to mock up returns and asset class mixes. You don't need that information. Now, I'm not saying you don't. I'm saying a person doesn't. And so you may not have actually looked at that. Second, I would also, well, third, I don't know. Another thing that I would point out just briefly is if you look at those returns, you can see what Callan assumes standard deviation is for all asset classes. And again, I would caution, and Callan knows this, they can talk about it again when they're here, the difference between infrastructure standard deviation of 15.5 versus large cap US domestics of 17 is really not a whole lot. So I would caution to the board to attempt to not be mesmerized by a 9 or 12% return, as both of our managers have had net of fees the past year.
Can you have a conversation, Mr. Revelis, about some of the requests and see if that can be on Callan's presentation so we can talk about it more thoroughly?
Absolutely.
Thank you. Any further general board member discussion? Any public comment regarding our general board member discussion?
There is no public comment.
Thank you. That takes us to item number 7. A notice of our next board of retirement meeting will be October 18th, a Wednesday at 8:30 here in the Board of Supervisors chambers, and we are adjourned.